in the inflationary environment that we have over the past couple of days, as we've discussed, over the past few weeks, as we've discussed, we've seen a lot of news surrounding inflation. Inflation
Mhm.
really is the enemy of every central bank of the world right now. And we just had this incredible announcement and with the FOMC and Jerome Powell yesterday. And I wanted to explore that a little bit and explain what that stuff actually means. So we're just going to go over a quick overview of some of the core things about the Federal Reserve and what FOMC even means to go over the full details, just super quick. The Federal
Mhm.
Reserve is a governing body here in the US that is a part of the executive branch. They work with the Treasury Department in order to make sure that the economy is running. The FOMC is the most important meeting that they have. They have it 8 times a year. It's the Federal Open Market Committee meeting. They usually have it 8 times. They can have it more than that if things go absolutely ballistic. Last year they had it 12 times. And at this meeting, 12 members of the board that you see here at this massive table, how they get that table in, I don't know. At this massive table, they sit down, they discuss the economy, they discuss monetary policy, and to determine what action should or should not be taken in order to make sure that things happen. A lot of what they pull from are from the Bureau of Economic Analysis, but they also use quite a few different things from the Bureau of Labor. It's a bunch of numbers that say, hey, are we doing good or are we doing bad on whatever they're focusing on? Which, of course, right now, the focus is inflation. Usually, when they're talking about all these things, they're keeping in mind two things. They have two goals. They want to make sure that they stabilize prices and that employment is high. This is what is
Mhm.
normally true of central banks across the globe. Stable prices mean that people can afford things. High employment means that people have money to be able to continually put money into the system. You have economic growth as a result of that. That's generally what happens. That's not what's happening right now.
Yeah.
Right now, there is a focus on trying to balance employment and inflation. It sounds kind of dark, but Jerome Powell, the head of the Federal Reserve, has repeatedly said that unemployment is just it's too low.
Mhm.
3.5%. That's near record lows for us here in the States. And that's great for your average Joe. It's not necessarily great for the economy at large because more people being employed means there's more money in the system, more demand goes up, therefore more prices go higher.
Yeah.
When you're talking about how the Fed actually adjusts these things, how they attack this stuff, a lot of it is very indirect. So you'll see them, like in this meeting that we saw yesterday, they'll use the Federal Reserve funds rates, they'll use the discount window, or they'll directly buy or sell bonds in order to change the space in some way, shape, or form. If you guys ever hear jokes about the printer running crazy, that's them
Then they
buying
go,
and or
"Brrr."
selling bonds. The printer go brrr, that's them buying bonds and putting money directly into the system. What the FOMC meeting is focused on is the federal funds rate.
Mm.
That's really the core and the most important part of this. The other items are important, but it's not as effective. The federal funds rate really is it's indirect. It's an indirect tool. Basically, what they're doing is saying the rate that banks are allowed to borrow from one another, usually overnight, is a certain amount in order to make sure that the banking system is quote unquote safe. I know that's hilarious considering the current kind of environment. We literally just had another bank fail on Tuesday, so take all this
But
with a
it's
grain of
safe.
salt. This is
It's
what they.
safe.
Oh, it's
Oh
safe.
yeah.
It's
Yeah.
totally
No.
safe.
No. They were
Don't
balling
worry
up.
about it.
They were
Don't
balling
worry
up.
about it, man. Shh, it's fine. So, considering the current climate, I know it's kind of crazy, but the Federal Reserve and the Treasury Department, they have rules for being a bank. You can't just be a bank. You have to have a certain amount of cash on hand to make sure depositors are protected. Again, I say all this in air quotes to make sure depositors are protected. But you know, banks have day-to-day operations. If
Mm.
people pull out a ton of money one day and they don't have the amount of money that they need in order to be a bank for that day, they have to take a loan. And they take those loans from neighboring banks. It makes a more friendly environment for competitors. Now, if you're taking a loan from another bank, If I'm taking a loan from Jordan, Jordan is going to want to gouge me because he wants me to go out of business so he could be a bigger bank. So in order to stop that from happening, the Federal Reserve steps in and say, no, 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 no. You can only charge this amount for a loan. It has to be between A and B numbers. That's the federal funds rate. Right now, that rate is between 5% and 5.25%. That's the rate at which Jordan can charge me for an overnight loan to make sure I meet my requirements to be a bank here in the States. And it's pretty similar across the globe. Not entirely the same, but pretty similar. So like a Chase to a Wells Fargo, they can only maximum they can charge each other 5.25% for an overnight loan. Now, yesterday, getting into actually what happened, the Federal Reserve, they raised rates. Some people think this was a great idea. Some people think this was a horrible idea, and the world's going to burn as a result. But this is what happened. They went into a meeting.
Guns and gold. Come on, you said
guns and gold. I hear an eagle calling somewhere right now. So super American. So yesterday they raised rates 25 basis points. You'll hear that a lot. Basis points is just another way of saying a percentage of 1%. So 25 basis points would be a quarter point raise, a quarter percent. 50 basis points would be a 0.5%, right? Mm-hmm. And like we said before, that brought the federal funds rate between 5% and 5.25%. That's significant because the last time we saw this was September of 2007. I don't know if any of you guys were around in September of 2007. I assume you were. It wasn't a great time for anyone in and around the financial markets. So people are a little nervous considering that's happened. Also, this is the guy with all the power. This is Jerome Powell there. So if you see that face, know that he controls the printer.
Do you sense a bit of animosity among investors? The fact that we've gotten back to that 2007 high. Now, obviously, the big crash was 2008, the financial crisis of 2008, right? Do you sense in the market that we're getting a little bit, whoa, what does 2024 mean? I mean, we see humans love to repeat themselves, right? The mistakes we make, the things we do, how often it takes for us to repeat what we do. Everyone goes through the same cycles, and we're seeing it again with war re-arising. We just don't learn. We do the same thing. Are we pushing towards that? Now, remember, I only like short selling, so I've got a bias here, right? I've got a bias with everything going to the downside. But what do you think from a standpoint, considering you're still holding some of these assets like Apple and like Amazon, and contrarian still buying gold as well? I'm really intrigued for your opinion on this.
Yeah, so it's as I always say, no one ever has a crystal ball, right? So I'm still looking for it. If anyone in the chat has a crystal ball, please be very willing to offer that up. I will pay you everything I have, and we can talk about my dog. But so I have to say yes in a way, Jordan. There's 100% animosity. I'm a really big follower of Scott Calloway. He's a really big economics professor over at NYU. He's despises what the Federal Reserve has been doing. He feels like they're in a horrible position, but you look at economists from Harvard and they feel the exact opposite. The reality of it is 2008 happened. We put a lot of things in place to make sure 2008 did not happen again. And then we repealed those things once the market started doing well. We literally created a situation where a SVB, a First Republic Bank, could over-leverage themselves and make mistakes that cost the system billions of dollars, that cost taxpayers billions of dollars. From a trading perspective, from an investing perspective, it's a nasty situation, because what are we supposed to think? We're in the same position seemingly as we were in 2007, and with at least the Federal Reserve and their positioning on things. Does this mean that there's worse to come? We saw a low in the S&P 500 in October of last year, but we have almost traded in a range since then. We hit somewhere around, depending upon which version of the S&P you're trading, 4,200 or 420 on the S&P 500. We get over there for a moment, and then we fall right back down. We get to 4,000. We seem to bounce off. It's a very weird very weird scenario, and a lot of people are nervous, and
I mean,
rightfully so.
who in their right mind would work for a central bank? You just cannot win. I mean, it's the same as being in politics, right? There is just no way right
Yeah.
now. You've got option A to get us out of this where people get hurt, or option B to get us out of this where people get hurt. And you've got to pick one of
Right.
these. And the worst thing is, I mean, the media is going to come for them. It's that you've got politicians are going to blame the central bank for the reason that their government copped all of this, what happened when they had to react. Like, it's just a lose-lose position to be. It is horrible.
It is. And you know the worst part, Jordan, the worst part is we've had a history of successful Fed chairs or chairs of the ECB or the Bank of England, and they're heroes after they die. So even if everything Jerome does works out great and he is Superman, he is Clark Kent until he's put into the ground. He is no one. There's
Yeah.
a really good example of this, and I don't want to go off topic too much, but
Mm.
there was this guy Paul Volcker in the 80s, late 70s, early 80s, who was the head of the Federal Reserve. Inflation went ballistic. People didn't know what to do. Prices were going absolutely crazy. Russia defaulted shortly after this. There was a lot of stuff going on at once.
Mm-hmm.
Paul rose rates, meeting after meeting after meeting after meeting to fight inflation, raised unemployment to levels that people felt were disgusting. Congress brought him in. They sat him down. They yelled at him for 3 hours. He sat there. He nodded his head, smoked a cigar. I understand. Went back to the Federal Reserve and raised rates again, regardless of what happened. People hated him. And then he died, and we realized that his actions made the 90s one of the most flourishing economies for the US. 1992 was the last time we had a surplus for the US government. That was under Bill Clinton. So it's an oddity because now you see guys like Jerome Powell, who's just trying to emulate a hero in Paul Volcker.
Mm-hmm.
But will he also be a hero? Will he be a hero, or he be in the chair long enough to become a villain?
Tough spot. Yeah. As I mentioned, politics. It's no, thank you, not for me.
Yeah, I'm much more comfortable sitting behind this desk pressing buttons all day, man.
Yeah, and just sharing my opinion. I'm not even in the US, but I'll yell at Jerome Powell. I mean, it's easy for me to do.
100%. It's much cheaper for me to have an opinion and be wrong and have nothing really happen.
Exactly. Sorry, I interrupted. Feel free.
No, you're fine, man. But yeah, so keep in mind, guys, 2007, rough year. That's where we're at from the Federal Reserve's perspective. This is one of the reasons why you have companies like Apple. We've already discussed this a little bit, but companies like Apple are trying to diversify their earnings. They're trying to diversify their revenue. Why? Because, right now, with rates getting more and more expensive, it's more and more expensive for banks to take loans from each other. So they're going to pass it off to the consumer. They're going to pass it off to any of their clients that they have. So it's going to be very expensive for companies to get loans, for people to get loans. So there are several companies that are trying to take action to diversify their revenue streams to make sure that when their earnings pop up, Apple has earnings popping up soon, by the way, they want it to look good so that their stock price doesn't take too much of a hit.
Mm-hmm.
And this isn't just true, as we've constantly discussed, this isn't just true of the US. This is true everywhere outside the Bank of Japan. The Bank of Japan does weird stuff. We can go into that later. Reverse rates are a very real thing. But everyone else is trying desperately to fight this inflation issue. And it's going to result in companies like Apple doing things to diversify their revenue, but it's also going to cause things centered in and around immediate effect on the stock market, where we see things go down immediately. But remember, we're not actually thinking about the present. We're thinking about the future. Mm-hmm. So even though the stock market is taking a hit immediately, these rates aren't going to be felt for some time, for some months. That's one of the reasons why you see rates being accelerated so much. 9 months ago here in the States, the interest rate was 0. Now it's 5%. To
Yeah.
give you context, in 2007, it took them over 2 years to get to that point. It was a lot more
Yeah, I
calm,
think
conservative.
we did some analysis about it last month. Someone in chat remind me when we went through the correlation hunting episode, but we actually found we predicted that it was about an 8-month delay between when you hike interest rates and when it truly hits the market, when it truly makes an impact on
Right.
inflation. We estimated around 8 months.
That's right on the money from what I'm able to read and what I'm able to gather. Keep in mind that we've been raising rates here in the States for 9 months, right on the
Mm.
ball. So we're starting to see some more aggression, and this gets into some of the things I was going to talk about a little bit later. But when you look at the amount of layoffs that we've started to see, these are layoffs specifically within the tech sector, which are some of the biggest headlines. But you start to see things get really aggressive. People started getting nervous, letting off a ton of employees.
Mm.
And although it has slowed down a little bit in the tech sector, it's starting to spread to other sectors as well. So it's great that you brought that up. But speaking of that issue of employment, it's central, as we were talking about before, to this conversation in and around these interest rates. We have to remember that high employment means high demand, means higher prices. Things are going to continually grow. And as you can see here from this news release from the Bureau of Labor Statistics, we're looking at this 3.5% number from non-farm employment. I'm sorry, from the unemployment rate. The non-farm payment payroll employment number rose by 236,000. These are things that are great in a normal economy when inflation isn't running rampant, but in an economy where things are a little bit more aggressive in terms of inflation, it's not where you want things to be. And right now, when you look at it, that's the Federal Reserve building there in the center. They're just trying to balance these two items. They're trying to see what's going to tip the scales between this economic balance that we have. On the right side, we want a really strong economy, we want stable prices, and on the right side, we have people. The reality of it is, unfortunately, every time unemployment goes up 1%, 10,000 more people die that year.
Mm.
It's a dark reality, but it's a reality that's very true. One thing that we saw from yesterday's meeting is the fact that Jerome feels that this might be a different kind of economy. For some reason, unemployment is very, very, very resilient. There's still a lot of job openings available here. And as you can see from the JOLTS number, that's another event that we'll go into later on. But there's still tons of jobs available. That hasn't really changed. And like we were saying before, now we just kind of sit and wait. In his meeting notes, or the press conference that you saw after the number is printed at 2:30 yesterday, Jerome hinted at the idea that they may just pause rates from here and watch what happens.
Mm.
The things that we've talked about already with PCE and CPI are going to be paid close attention to. And if those numbers continually balance out, if we print a CPI that's below 5%, for example, next month, then hey, maybe this is working. But if things grow again and we start to see numbers closer to what the Bank of England is experiencing, hopefully it doesn't double overnight from 5% to 10%. But if we start to see those types of things, then the Federal Reserve will have to make historical changes and hit rates harder.
Mm.
So I say all this to say the Federal Reserve and central banks across the world are focusing on inflation. When you see these meetings happening, this is what's going on within the minds of these economists, these people that have spent their whole lives studying economies and how they work. And even then, they might make mistakes. They might be right. They might be wrong. This might be a fight that we experience for years. This might be a fight that we see for 2, 3, 4, 5 years. But it's always better to be more educated and to understand a little bit more about what's going on in the markets.